Fed does what the Fed does, and they announced that, guess what? We're going to go ahead and raise another 0.75. Let's shift gears here a little bit. Sarah, with the amount of 0.75 rate hike today, I want to hear your thoughts on this, how it's going to impact the actual interest rates that people are having, because there's a lot of people saying interest rates are going to continue to go up. I'm one of them. I've said interest rates are going to go up, but we also have had people on this channel who said interest rates are not going up. They're going to go down in October. So with this 0.75% interest bump, or not interest, but percentage bump, what do you think is going to happen, and what's on your radar?
Yeah, sure. So I think, oh yeah, it is on. Good. No, what I was going to say is that the 0.75 rate hike, Fed rate hike today was received well. It was kind of leaked before that they were thinking about 0.75 or 100 and or 75 bips or 100 bips, which is 0.75 or 1. And they did land on 0.75. That was leaked, and that was received well. There was no surprises. Honestly, usually what happens isn't the announcement of the rate hike itself, but it's the conference that Jerome Powell has with everyone post the announcement. And everyone is usually hyper focused on everything he says and they nitpick it to death to see if there's any clues in there on where the Fed's head is at and what they're thinking about doing in the future. So that's usually what actually ends up being more impactful than the announcement of the Fed hike itself, because everyone knows that's happening. Now, with that being said, there were no surprises in the press conference today. And usually you can expect some sort of knee-jerk reaction both ways when there's the day of a Fed rate hike, but that wasn't really the case today. We've been holding strong. Rates actually started seeing an improvement since the European Bank announced that they were doing a rate hike themselves for the first time in 11 years last Thursday. We actually saw a boost there because it was well received by the bond market, because it's showing a global combating of inflation. And so the 0.7 rate hike is a good thing in regards to mortgage rates. It doesn't mean your mortgage rate is going to go up by 0.75%. What it means is that the Fed is combating inflation like we were hoping they would do, and it's actually going to cause rates to get better. And as they continue to do the Fed rate hikes to combat the inflation issue, we should see interest rates start improving. And kind of what I talked about at the beginning of the year, the last couple times I was on here, is I was saying that at the end of the year, we should start seeing some improvement in rate. And so we're starting to slowly see a little bit of that now. And I think once the once the GDP report comes out the second quarter in September, and it shows that we are in fact about to hit a recession, I think that's when we're really going to start seeing more improvement at the end of the year.
So people understand how the bond market works and how interest rates work. Explain that a little bit, as far as interest rates for homes don't necessarily correlate to what the Fed does. So why don't you explain that real quick?
Yeah. So the Fed rate is like the daily rate of something. So so when the Fed increases their rate, it's going to directly impact short-term financing and short-term loans, like daily interest on things. But when you look at a mortgage, it's long-term. It's we're looking at a 30-year loan. You're looking at 30 years, 25 years, 20 years. So when we look at the bond market's looking at the Fed rate and the economy and being like, okay, where are we going to be this year down the road, like 30 years down the road, 20 years down the road, because they're holding a note when they're selling bonds. They're going to be, sold and holding that for a longer period of time. So the Fed rate immediately affects short-term interest accruing items, but not in credit, and it directly impacts long-term interest and credit differently, because that's more of the long-term outlook of where our economy is going to be. So if we have a positive outlook and it's more solid economy, then it's going to be a positive influence on the bond market. So Fed raising rates right now to decrease inflation, so we have a better, more stable economy, is a positive for the bond rate, which is positive for mortgage rates, meaning that mortgage rates will improve because there's going to be, that outlook of a more positive economy down the road. I hope that's a little clear. It's a little technical.
No, it's good, because I think the average consumer doesn't understand or doesn't really realize where or how the rates are derived for these. And so they hear Fed's going to raise rates. That means that interest rates are going to go up. And so in their mind, that's what that means. Or if the Fed lowers the rate, that rates are going to go to zero. You're going to get a free home. That's not the case either. So it's good to break that down. Guys, what questions do you have for Sarah when it comes to all this?
My first thought is, do you agree with Mr. Squatting Bear's comment that just popped up that it would take until early Q1 of 2023 for the rates to see an improvement? Or do you think it would be sooner than that?
I think that we most likely will see something either end of this year, beginning of next year. I think that's in line. I don't think that that's super optimistic. I think that is in line with what we've been seeing. And now, especially with what the announcement that happened last week with the European Bank and what we're seeing right now, we have seen a steady improvement since the June rate hike. So since the June 15th rate hike, we have seen a steady improvement in and when I say improvement, no, I'm talking about like tiny numbers here. Because I'm talking about like an eighth of a point, like half a point, things like that. So, but we've seen an improvement and we've seen it stay steady. And so we've seen kind of like a little stair step. And so with this rate hike, we're going to see that continue to stair step most likely. That's the projection, because everything's following what I've been saying is that we're combating inflation. That's all they want to see. And then once we have that under control, then rates are going to start coming back down. I don't think they're going to come back down in the twos or the low threes, but they're going to start coming back down.
So your most recent lock that you can think of that had no anomalies, no variables, just a standard W-2 employee with a 740 credit score, what were they looking at?
So we did with a 30-year fixed, it was in the, I think it was like 5.25 around there. It was in the fives. And then for ARMs, which would generally end in a high, and when you have high inflation and with the market like this, sometimes ARMs make more sense because they're looked at a little bit differently because they're based either on like LIBOR or something like that. So it's a different type of market. Like those right now are, if you don't buy points, that most of those are in the fours right now. So it just depends.
How many of your buyers are buying points?
Ooh, that was my next question.
It's a good question. So right now, if someone is going under contract today, honestly, like I don't recommend buying points in this market right now. I don't think that that's a good move. Just because most likely because everything is pointing at a recession. Like we have inverted yield curve. We have, we have high inflation. We have already projected numbers for second 2 quarters in a row of negative GDP. Like the only thing left is job report. And honestly, the job report numbers are skewed because how they calculate it is they net it out. So we actually have higher unemployment, but more people have gotten out of the job market where it's netted out, where that unemployment number stayed the same. So that's the other shoe to drop. Once the unemployment number comes out and that goes higher, then that's like, those are all the indicators of a recession. So,
what would a recession mean for interest rates?
It means interest rates will come down.
And everybody should pray for a recession.
Historically, yeah. So historically, well, yeah, if that's what your goal is, if your goal is lower mortgage rates, yes, globally, when a recession happens, mortgage rates go down. And that historically, that's happened every single time we've had a recession. And so once that happens, like we're already prepped for it. We already know whatever, most likely any clients that lock in a rate right now, they're probably going to be refinancing in the next year or two. So I'd much rather them save that money and not spend a ton in points. I had someone come across yesterday, they're spending 2.5% in points, or 2.5 points, I'm sorry, for a rate. And I'm like, well, that might sometimes, it depends on everyone's scenario. It may make sense for you. I don't know. Everyone is different. So I can't do a blanket statement like that. But most of the time, it doesn't make sense with the market right now today to buy points because most likely you're going to refinance into that lower rate and you might as well use that money for other things.
Thanks for watching this short of the Real Amigos podcast. For more live streams, hit here. For more clips, hit here. We'll catch you on the next one.